Hey guys, welcome back to Keeping Up with the Kinneys. I'm Matt.
I'm Jade.
And again, thank you very much for tuning back into our series, The Baby Step Breakdown. So we've enjoyed making these videos for you guys, and hopefully you've enjoyed them, and hopefully they, more importantly, been helpful. So in this video, we are going to talk about Baby Step 4. And what that is retirement and investments. Investments. Okay, so
we're gonna put 15% into retirement, and 15%. We're gonna tell you how.
That is word for word. That's Baby Step 4 is to put 15% into retirement.
Correct.
Okay, so we are going to talk about the different types of funds: index funds, mutual funds, retirement accounts, and where to put your money, what's the best options, and also who can you talk to, because that's a daunting task. Who do you go to talk to? Who can you trust? So
yeah,
please stay tuned, like and subscribe to the channel if you would. If you enjoy the content, leave a comment if you would.
And without further ado, let's get into this video. All right, so we're gonna get into this very first section of this video, which is what is an index? Because there are so many terms that are thrown around when it comes to retirement, investing, the stock market, and no one has any idea what people are talking about. Like, you hear all of these terms on the evening news, like the Dow Jones Index, the NASDAQ, the S&P 500.
Most people only know to freak out when they hear it goes down.
Right.
But no one knows what it is.
And what is it? Why is it changing? And all it is a mathematical equation that gives you a calculated average of how that group of stocks is doing. So each of these indexes holds certain stocks. So the S&P 500 holds the top 500 companies in the United States. So there's big names in there, Coca-Cola, Walmart, Google, Apple. All kinds of different things are within that index. They have to meet a very specific criteria, have a certain amount of time where they have gains in the market and profit, and they have to prove all of that. So like Tesla right now is going through the process of getting into the S&P 500. So that is that index. So the S&P 500 index is a mathematical equation. You can't actually purchase the S&P 500. So when you type in the S&P 500 onto Google and it brings up that chart of that it's worth like $3,200, I think is what it's worth right now, that you can't purchase what it's telling you right there. You have to go purchase a fund of the S&P 500. So it's just an index that lets you know how all of those companies within that index are doing. There's also another big one that's the Dow Jones Index. That has the top 30 companies within the United States. So again, Johnson & Johnson, Coca-Cola, Walmart, all of those are within that index. It's just a little bit smaller of an index. However, most people use it to give a very broad how the economy is doing. They use that one the most because those are the biggest companies. If those companies aren't doing well, then most likely the mom and pop shops aren't doing well, and the smaller companies aren't doing well. So that one's used a lot for that. There's also the NASDAQ, which is 3,000 stocks are held within that, but it's more tech-based. So it's another index that lets you know more so how the tech field is doing. And then you have the MSCI index, which is a global index that lets you know how the global economy is doing. So that's just a little bit of the down and dirty of what are the indexes and what do they mean, because you can use the ups and downs of those to kind of track how your investments are doing. If it goes down, guess what? That means that your stocks are on sale. Buy more of them. You just need to watch it, not to get scared. Don't watch it in order to get scared, but watch it so that you can be responsible in your investment purchases and know if it's a good time to switch things around or not. So that's just what indexes are, because we are going to talk about index funds within this video. And just knowing what the indexes are is important when it comes to investing. So I think that wraps up this section, because I probably lost a couple people. Their eyeballs probably glazed over, because that's a lot of information and it's a little bit boring, but I'm trying to make it fun with my outgoing personality. So we'll move on to retirement account.
All right, so to talk a little bit more about retirement accounts, essentially they're a lot like savings accounts, and it all depends on what you put into that account and how that can grow. So you're gonna need stocks or bonds to put into that account. And you probably heard of the main accounts, your 401ks, IRA, TSP, 403b, Roth IRA, and a Roth 401k. So with those different accounts, they give you different benefits, and I would say they give you different benefits, and that is tax incentives. So 401ks and IRAs will give you pre-tax dollars, and all that means is that you get the break now. You get the money prior to being taxed. So you take that money, you put it into the account, and you don't have to pay taxes on it. But when you want to retire, you will have to pay taxes on that total amount that you're going to withdraw. And you have other options like your Roth IRAs, which what that is after tax dollars. So you pay the taxes now, and then 50 years from now when you retire, you want to pull all that money, it's already been taxed. That's 100% of your money, which can be beneficial depending on how much you make and how much you put into retirement. Because if you're putting, $100 now, and say you're going to take out your portfolio is 1.4 million, and you pull that out and you haven't paid taxes, well, now you're paying taxes. If it's sitting in a 401k or an IRA, you're paying taxes on it of $1.4 million. You're paying taxes on that, opposed to just throughout while you're putting it in. So it just depends on,
are you going to make more now or later?
Now or later. If you expect to make more money in retirement than you do right now,
Roth.
You need to do a Roth, because you don't want to be taxed on $1.5 million. You want to be taxed now. So it's a big benefit that I didn't know about for the longest time. So it can put you in a really good position if you're aware of that.
Tax-free growth. That means all of that money that because you are only contributing a small portion of that amount. So you may have paid taxes on $200,000 that grew into $2 million.
Yeah.
And now you're not paying taxes on that $2 million. You paid taxes on $200,000.
Yeah.
So it's a huge amount of savings, and it's a huge deal that more people need to know about, and that's why we're including it in this video.
Yeah, because people will think, well, I want the money now, put it in there now, I'll worry about getting the tax about it later.
Yeah.
But if you don't do the math and you don't think about that, it can really hurt you big time. You'll be losing hundreds of thousands of dollars just because it's taxed.
And the opposite of that is true if you're starting later in the game and maybe you're retiring in 10 years or something like that, and you're like people that we know that might be making less in retirement than now, then maybe you want to get your tax burden decreased now and be taxed later on. So you just have to kind of see where you're at right now, where you're going, and is it more or less, and then that will let you know Roth or traditional. You also can only put $6,000 into a Roth IRA per year. So that's also another thing, is that it's capped on how much you can put in there. It's not like
you want a Roth IRA.
Correct.
Get a Roth IRA.
But you also just need to make sure that you know only $6,000 a year can go in there. So there's other money that you need to allocate other places. So you're going to put other money maybe into an IRA or a 401k or somewhere that you're actually going to do the tax burden relief now and, pay taxes on it later. But yeah, that is kind of the retirement stuff. all wrapped into a
Yeah,
little
so
type
again,
O.
that's retirement. That doesn't equal investments, and we will talk about that now.
All right, so now we're gonna get into the nitty-gritty of one of the biggest parts of this video. It's going to be a little bit lengthy, sorry about that, but there's so much information for me to tell you that it's a big deal.
Yeah.
So, like Matt said, within a retirement account, it means nothing if you have nothing in it, just like your savings account literally is nothing if you have no money in it. So the investments that make up that account are the thing that matter. So we're going to get into those. So those things can include things like stocks, bonds, mutual funds, index funds, international funds, REITs, ETFs. We'll get into what all of those are if you just stay tuned. So mutual funds, or no, I want to start with stocks. We'll start with stocks and bonds. So stocks, you own a small portion of a company. A bond is you kind of lend money to, let's say you can lend money to the US government. And it's a really safe investment, but it also doesn't give you very much money. It kind of just keeps up with inflation, really. It gives you like 3% to 5% back.
And
So
single stocks are risky too.
those are very risky.
Stocks, single stocks, it's the same thing.
Yeah.
Okay, stocks, you like the Robinhood app,
Mhm.
you can buy individual stocks for, $10, $15, $20 for one stock, whatever it may be. And there are people out there that can make a lot of money, but it's a lot riskier. And
It's a lot like gambling.
Yes, that's all you're doing.
Yeah.
You're gambling because no one can predict the future.
Correct. So another section of stocks, but that help it automatically, boom, diversifies you is a mutual fund. So mutual funds are, you own 300, 3,000, whatever the amount that is contained within that mutual fund. I think the minimum is 90 companies. So you own stock in all of those companies. You and some other people mutually put in money. So Matt puts in $10, I put in $10, and then 100 other people put in $10, and then we own that fund together.
Yeah.
So
That's
that
a good way of putting it.
fund is mutually funded, and that's where the term came from. It's
Shocker.
also the largest kind of umbrella that other things fall under. So one of those other things you may have heard of is an index fund. So an index fund is a fund of an entire index. And what did we talk about earlier? Indexes are like the S&P 500. So that means you own all 500 of the best companies within the United States. You own a little piece of all of them. Google, Microsoft, maybe Tesla, in a few months, who knows? Walmart, Johnson & Johnson, like there's tons of big companies that, Coca-Cola, that are in there that you then own with owning a S&P 500 index fund. Super safe investment. So we talk about active and passive investment, and passively investing in an index fund is pretty safe because the S&P 500 has an average return of about 10% over its history. So it's a pretty safe bet that you'll get a 10% return on your investment, and that's the growth rate that you can expect from that. You also then own that entire index, so it's safe in the fact that you're very diversified in 500 big companies.
Yeah, and everyone shares the risk too. So
Correct.
again, since everyone is sharing, the profits as well as the risk, it's something goes south, you lose less money. So
Yeah, because they're normally much less expensive to buy into as well. Because if you want to buy, Google, a stock in Google,
Yeah.
it's pretty expensive. But you buy an S&P 500 index fund, it's actually almost equivalent of buying one of those stocks to own a portion of the company as to buy an index fund that owns the entire index. So it's a little bit cheaper of an option too. Another type of mutual fund is an international fund. So this is where you own international stocks. So that can be things like Toyota, Nissan, Volkswagen. I can only think of car companies right now, because you want to make sure that you have lots of things and lots of different avenues, so that because the market will go up and it will go down.
Yes.
Proven 100%. You cannot prove me wrong on that. It will go up and it will go down. That will happen. So for you to not freak out when it goes down, you need to be diversified.
Yeah.
So
don't put all your eggs in one basket.
Correct.
That's all this means.
Lots of baskets.
Yes.
You need all the baskets. All right, so another type of investment is a REIT, or a real estate investment trust. So that allows you to kind of be a real estate investor without ever touching real estate. And each person who pays rent into that, you get a dividend from that. REITs often pay really high dividends. What a dividend is that you get payment every month, quarter, year, depending on what the setup of
You've seen them. You usually get dividends in your
in your savings account.
You'll randomly see 80 cents.
Right, yeah.
In your checking account quarterly.
So that's a type of a dividend. These are just much higher rates, like 5%, 6%.
Yeah.
REITs also decrease volatility. The real estate market is not nearly as volatile as the stock market is. The next thing that I want to talk about are ETFs, which are exchange traded funds. They're pretty much the same as an index fund. However, an index fund, you can only buy and sell once a day. So like it's not 24 access to the market like an ETF is. So ETFs, you can buy and trade all day and all night. However, you shouldn't be doing that anyways. So I don't really see it as big of a benefit to an ETF when you're doing a long-term investing, like the tortoise and the hare, and you're just wanting to make sure that you have money in retirement. All that ETFs really give you is when you see the stock market drop, it gives you the option to try and pull your money out. And there's not too much gain that you would get as a long-term investor. Okay, so now we're going to get into what Dave Ramsey talks about all the time, which are the types of mutual funds that he invests in himself and thinks that everyone else should too. We discussed all of the other options, but now we're just going to go into the Dave options.
Yes. He has 4 main options, which are growth, aggressive growth, growth and income, and international. Which are 4 mutual funds that he likes to. He tells
everyone to go after.
Go get those.
Which we already discussed international because I already brought it up.
Internationally funded. Mutually funded.
So you have growth and income. These are like the slow and steady. There's not much gonna happen with them. You own really big corporations. So you own large cap corporations, which are any company that have a value of over $10 billion.
Yes.
So you're not going to see very much flux in those stocks within that fund. That's things like Google and Apple and stuff like that, where like it's a big company, it's already a big company, so it's gonna keep going up.
Yeah, the chances of
it's not gonna fly off the charts. And then you have growth mutual funds, which are moderate risk, moderate reward. Those are any companies that are valued between $2 billion and $10 billion. So those are still very big corporations, still make a ton of money. However, you can see a little bit more fluctuation in the prices. Then you have aggressive growth. These are your startup companies, your littler companies that are
we
volatile.
wish you would have bought a mutual fund in Netflix
when it was not what it is.
Yeah.
Yes.
Those type of things.
So it's under $2 billion worth, which are tons of different companies. You can have huge gains, and you can have huge losses. So those are where you're going to see a lot of change in the stock prices, good or bad.
Yeah.
So those are, especially if you're getting closer to retirement, you're going to want to back away from.
Yeah, you don't want to risk it. When you're
Correct.
getting close to retirement.
Right. So that kind of wraps up investments. Now we're going to get into the who should you talk to portion of this video.
Yeah, so you got different types of people. You got, agents or brokers, and you also have what is called a fiduciary.
Correct.
Have you ever heard of that? Because I didn't until a while ago. Okay, so I am new to that term.
And I hadn't heard about it until I read Tony Robbins' Unshakable. Great book on investing. You should read it. It's great. I loved it.
Tony Robbins is the boss. But yeah, because that's what I was like, where do you go? Where do you go? What company do you go to? There's so many people out there. I don't know these people. Why do I want to give my money to this person and say, here, make me money? Why do you care? I get it. They're going to make money off of me, but how do you know if you can trust them? And then Jay goes, well, that's why you find a fiduciary.
Whereas a regular stockbroker just has to make suitable recommendations.
Yeah.
So that they don't have to have your best interest in mind. Those suitable recommendations can be things that make them more money over what's best for you.
Yeah. But now she explained what that was to me, and that helps with your concerns, anxiety of, can you trust this person? So that just kind of helps, knowing that they have to do things on your behalf.
But none of this even matters if you don't start.
Remember, this is baby step 4, okay? So this is not, you don't do it before 1, 2, or 3.
Yeah.
You do it after. So
Right.
just with all this info.
You have so much money now because you have no debt in your life.
Don't add additional investments until you hit baby step 4, until you're out of debt and you have your fully funded emergency fund.
Also, quick little thing, any of the little graphics that have been in this video, if you want to head over to our Instagram, it is Keep Up with the Kennys instead of Keeping Up. Tell whoever stole my Instagram name, I'm coming after them. But no, for real. It's on our Instagram. If you want to look at it a little bit more in depth, or you just want to look at it again, it is on there. It will be on there. Like I said, Keep Up with the Kennys is the name of our Instagram. Make sure you like and subscribe to this channel. We have loved this journey so far. We hope that you are enjoying it too, and that we're teaching you something useful. And we will see you on Friday for baby step 5.
5.
All right, have a good week. Bye.